Good afternoon, Sir Sharil. My name is Wong See Nie. My metric number is 261359. We are from Group 15. Would like to present about money market instruments. My group members included Arasu, Sivathashann, Arasu, and Phan Xin Yi. I will have some briefly introduction of money market instruments in Malaysia. First, certificate of deposits is a financial product offered by financial institutions that allow customers to earn interest on their deposits, and in return, they must leave the deposits untouched for a certain period of time or risk paying a penalty if it is withdrawn earlier. Next, repurchase agreement is a short-term sale between financial institutions in exchange for government securities. The two parties agree to reverse the sale in future for a small fee. Most repos are overnight, but some of them remain open for weeks. They are used by business to raise cash quickly. At the same time, it's used by central banks too. Besides, banker acceptance is a short-term issuance by the bank that guarantees payment at a later time and often used in importing and exporting, with the importer banks guaranteeing payment to the exporter. Moreover, Treasury bills is talking about short-term securities issuance by Bank Negara Malaysia for capital requirement purpose. They are issued with maturity of 3 months, 6 months, or 1 year, while the Islamic one issued on weekly basis with 10 years maturity.
Hi, good day everyone. My name is Arasu Ramasamy and my matrix number is 264922. I will be presenting about the banker acceptance. The banker acceptance in Malaysia is regulated by Bank Negara Malaysia, and it also sets a certain guidelines for the banker acceptance. Firstly, we will go through the definition for banker acceptance. A banker acceptance is a short-term issuance by a bank that guarantees payment later time. A banker acceptance is often used for importing and exporting, with the importer's bank guaranteeing payment to the exporter. Next, the purpose of banker acceptance. Usually, this banker acceptance will be used for financing imports based on cash terms and exports on credit terms. And the picture in the right of the video is an example of banker acceptance. Now we will be going through about more in detail on the banker acceptance. Firstly, the creation of a banker acceptance. Usually, a banker acceptance will be created by an importer to finance his purchase of goods from the foreign supplier. Firstly, an acceptance credit facility is arranged with the bank. Means here the importer will draw a banker acceptance on his bank to finance his purchase goods from the supplier, and then it required documentary evidence of the trade which must be presented to the bank. This is for the purpose of drawing a banker acceptance on the bank. And then when the bank is satisfied that the documents are in order and the banker acceptance complies with the terms of acceptance, credit facilities, and all the applicable conditions for the creation of banker acceptance specified in these guidelines, which means the bank accepts the banker acceptance. Next, I will be explaining about the parties involved and their rights on a banker acceptance. Firstly, the parties involved in a banker acceptance are the importer, bank, and an exporter. And the rights of each parties are, first, for the importer, he or she has their own right to choose which bank they are going to apply for a banker acceptance, and it continues with the banker, and the banker has its rights to choose their credit-worthy customer and the rights to claim the money if the bank pays the exporter at the maturity. Lastly, for the exporter has their own rights of collecting the money from the bank if the importer fails to pay the money on the maturity date. All these parties has their own responsibilities and obligations on a bank acceptance. Firstly, as an importer, he should know his responsibility of having a required document when applies for a bank acceptance, and also he should pay the bank on the correctly on the maturity date. Then as a banker, they should check the credit worthiness of the customer who applies for the bank acceptance, and also they should check on the eligibility of the customer to have a banker acceptance or not. And for the exporter, the shipment of the goods should be on time, and he should send the shipping documents and the time draft to his bank on time after the shipment of the goods. Other than that, there are also certain risks to the parties which are involved in a bank acceptance. Firstly, the credit risk. The credit risk is all about the importer will be unable to make payment at the maturity of the bank acceptance, leaving the accepting bank responsible to make payment. In addition, bank acceptance contains credit risk not only for the bank creating the acceptance, but also for the exporter, for the banks purchasing another bank's acceptance, and for the other investors such as state and local governments, insurance companies, and others. Then the next risk is reputation risk. In this context, in a banker acceptance activities, a bank lends its a good name to a transaction. Therefore, it is important that the customer requesting the bank's acceptance transaction have a sound reputation, as the banker's acceptance are generally created only by reputable, well-known banks with a good credit standings, thus making such instruments safe. Other than that, the foreign currency translation risk. Here, the banker acceptance created in foreign currencies, not in US dollars, are subject to foreign exchange dealing and position taking risk. The risk to earnings or capital is from movement of foreign exchange rates versus the US dollar. And finally, the credit risk. Since most banker acceptance are short-term, the market usually views acceptance as a safe and liquid. The fact that name banks dominated acceptance financing also limits the liquidity risk. The liquidity risk will be greater if the accepting bank is lowered rate, is not a name or prime institutions, or if the instrument is not eligible for the Federal Reserve discount. Moreover, there are also certain benefits on a banker acceptance. Firstly, the smaller financial risk. The reputation of a bank plays a huge role when a seller is reluctant to sell something to a buyer who still has no positive reputation. In such case, a guarantee from a bank ensures the seller that everything will be paid and that the buyer is worth trusting. The second one is the bigger possibilities. Again, it's the matter of a reputation, because a buyer who is backed by a known and respected bank can attract more sellers, and a business with a guarantee from bank can receive better investments. And the third one is a very low cost. The guarantees from bank are worth something. However, the interest rate is usually very low, and it's well worth to the opportunities you receive in return. The cost will hardly influence your profit a lot, but you will receive a new partner, a whole bank. And the last one is no payment in advance. If you are backed by a bank, nobody will demand advance payment. You will be too reliable for all the stuffs. On the other hand, you will have a chance to use the fund as due before you need to pay. Next, I will be explaining about the pricing mechanism on a banker acceptance. Banker acceptance rates are the market rates at which bankers' acceptance trade and are determined by current values of the bank. relative to face value. They represent the return received if an acceptance were purchased today at the market price and held until the payment date. The rate are bankers' acceptance rates, which include the bank's commission. Next, here is an example of chart which shows how a banker acceptance is being traded. Firstly, the American importer wants to import goods from the exporter from Japan. In these situations, two banks will be involved, which is the issuing bank and the beneficiary bank. Then the importer will issue banker's acceptance to the issuing bank, and the bank will sign the banker acceptance as an acceptance. After the maturity date, if the importer can't make the payment, the bank will take responsibility to pay the exporter in behalf of the importer. Then the dealing with the importer and exporter is over. So the importer just need to pay his bank. Finally, the banker acceptance in secondary market. Since banker acceptance are an unconditional obligation by a bank to pay at the maturity date, the investors consider them very safe in investments, and an active secondary market exists in it. Bankers' acceptance trade as barrier instruments at a discount from face value. For example, if an accepted draft has a face value of 100k, the holder would be able to sell the draft for a lesser amount, let's say 97,000 ringgit, in a secondary market. The discount amount fluctuates with the current interest rate. And that's all from me. Thank you.
Hi, my name is Arasu and my metric number is 261485, and I will discuss one of the components in the topic, which is Treasury bill. Okay, here is the definition of Malaysia's Treasury bill, which is the short-term security issued by the Bank Negara Malaysia for the government working capital requirement. And Malaysia Treasury bill are issued with original maturity with 3 months, 6 months and 12 months. However, in Malaysia, the Treasury bill will separate to two. One is Malaysia Treasury bill and second is Malaysia Islamic Treasury bill. The difference about the Islamic Treasury bill is its short-term security based on the Islamic principle, and it also issued by BNM, Bank Negara Malaysia. And Malaysia Islamic Treasury bill are usually issued on a weekly basis with original maturity of 10 years. And now is the feature of the Treasury bill. First of all is the issued price of the Treasury bill. Treasury bill are issued at the discount price. However, they are redeemed at the par value at the time of the maturity. Second is the eligibility of the Treasury bill. It is individual, company, firm, bank, trust, insurance company, provident fund, state government, and financial institution are eligible to purchase the Treasury bill. Third is the liquidity of the Treasury bill, which is the highly liquid negotiable instrument, because Treasury bill are available in both financial market, which is primary and secondary market. And last is for the risk of the Treasury bill, which is the Treasury bill have zero risk of default and the yield are assured. Okay, here I will discuss about the advantage and the limitation of the Treasury bill. First of the advantage of the Treasury bill is the risk-free. Investors have total security on their fund invested as they are backed by the government. And the second advantage of the Treasury bill is the Treasury bill have the high liquidity, because it is allow the investor to convert their holding into cash during any emergency time. However, the limitation of the Treasury bill, the first one is interest rate risk, which the rate could become less attractive in a rising rate environment. Second is the low return. The return generated by the Treasury bill remain fixed and irrespective of the financial market movement. And here I will discuss about what influence the Treasury bill price. First of all is the maturity date, which the Treasury bill with longer maturity date tend to have higher return than those with shorter maturity date. Second is the market risk of Treasury bill. The Treasury bill price tend to drop when other investments such as equities appear less risky than the Treasury bill. And the last is the Federal Reserve. A rising Federal Reserve fund rate tend to draw money away from treasuries and into higher yielding investment. Okay, that's all the discussion about the Treasury bill, and I will pass it to my friend.
Hi, my name is Phan Xin Yi, matrix number 263341, and I'm going to continue with my part certificate of deposit. So what is a certificate of deposit CD? A certificate of deposit CD refers to a financial product that offered by financial institutions that allow their customer to earn a certain level of interest on their deposit. And in return, they must leave the deposit for untouched for a certain period of time, or risk of paying a penalty if it is withdrawn earlier. A CD is a saving account that pays a fixed interest rate over a certain period of time or terms. Common terms include of 3 months to 60 months, and there are several or many types of CD that are available in the market, such as traditional CD, bump up CD, step up CD, liquid or no penalty CD, zero coupon CD, callable CD, broker CD, high yield CD, jumbo CD, IRA CD, add-on CD, and also foreign currency CD. So what is the common type of CD we can find in Malaysian markets? First, traditional CD. With a traditional CD, we deposit a fixed amount of money for a specific terms and receive a fixed interest rate. We have the options of cashing out at the end of the terms or rolling over the CD for another term. Traditional CD usually come with penalties for early withdrawal, and the penalty of early withdrawal can be steep and will enroll our earnings and possibly our principal also. This fee must be disclosed before the account was opened. Second common CD that can be found in Malaysian markets is a negotiable certificate of deposit (NCD). It is also known as a jumbo CD. It is also one of the type of the certificate of deposit. So, what is a negotiable certificate of deposit? A negotiable certificate of deposit (NCD) is a receipt for a time deposit in ringgit placed with commercial bank. Unlike the receipt for ordinary fixed deposit, the NCD is negotiable. The name of the deposit is not stated on the NCD, and the issuer undertakes to pay the principal sum of the deposit to whoever is the bearer of the NCD on the date of maturity. NCDs are issued for multiple of 3 months to 5 years, with dominations of 50,000 to 1 million ringgit Malaysian. These are the features of the negotiable certificate of deposit (NCD). The first one, NCD can be traded in a highly liquid secondary market. Second, because NCD are so large, they are usually purchased by institutions and wealthy individual investors. Third, however, they cannot be redeemed before maturity. And NCDs are believed to be able to overcome the shortcomings of fixed deposit because they can be traded through discounting process. Here are the more details about the negotiable certificate of deposit (NCD) in Malaysia. Bank Negara Malaysia introduced negotiable certificate of deposit and banker acceptance in May 1979. Banker acceptance are financing instruments to facilitate trade, while NCD are instruments that used to collect the saving from the general public. NCD are believed to be able to overcome the shortcoming of fixed deposits as they can be traded through discounting process. Several religious developments have been taken place in the NCD markets since the introduction of these instruments. Floating rate negotiable certificate of deposit introduced in July 1998, followed by zero coupon NCD that introduced in February 1993. Today, negotiable instruments of deposit that can be issued by banking institutions and traded in the Malaysian money markets consist of the following financial instruments. First one, short-term NCD. Second, long-term NCD. Third one, floating rate NCD. And the last one, zero coupon NCD. Here are the explanations of different types of NCD. First, short-term negotiable certificate of deposit. A short-term NCD certifies that a sum in Ringgit Malaysia has been deposited with a commercial bank or merchant bank or a finance company that issued the certificates, and the money will be returned to the certificate holders upon the surrender of the certificates through the accredited custodians. For example, a commercial bank or any banking institutions are appointed by Bank Negara Malaysia to act as the third parties responsible for safekeeping of the certificates. The maturity periods of short-term negotiable certificate of deposits range from a minimum 90 days to a maximum 364 days. The interest is paid by the issuing institutions at the specific coupon rate on maturity date. On maturity date, the accredited custodians collect on behalf of the short-term negotiable certificate of deposit holders the coupon interest and also the original deposited amount. The difference between the long-term negotiable certificate of deposits from others than CDs is the long-term NCD can be issued for a minimum maturity period of 12 calendar months, subjected to a maximum period of 60 calendar months. The interest is paid every 6 months with the exceptions of interest payment that may have to be made before the expiry of 6 months. Next, floating rate negotiable certificate of deposit. The difference between the floating rate NCD with other NCD is in the features of the maturity periods. The maturity periods of floating rate NCD range from a minimum of 12 months to a maximum 60 months. The floating rate NCD are unique in the sense that they bear interest rate that vary with the specific reference rate. Interest payments are made every 3 months or 6 months at the coupon or interest rate that are adjusted based on the KL interbank offer rate. The last one, zero coupon negotiable certificate of deposit. The maturity of a zero coupon NCD range from a minimum 3 months to a maximum of 60 months. Zero coupon negotiable certificate of deposit do not pay any interest. At maturity, the accredited custodian acting on behalf of the zero coupon NCD holders surrender the certificates concerned to the issuing institutions in exchange for the full remit of face value of the certificate. The NCD is one of the financial instruments in NIDS, which is a negotiable instruments deposit. So the NCD also can be traded via 3 different means. First one, absolute sales and purchase. For example, the ownership of the NCD is transferred from the seller to the buyer without the involvement of any third parties. This means the buyer can make no claims against the seller should there be any problems related to the NCD concerns. Nevertheless, the buyers can seek recourse from the issuing banking institution. Second, purchase and redemption transactions, which must be complete by the majority dates of the NCD as specified by the issuing institution and with the last repurchase agreement. Okay, here are the advantages of the NCD. First one, low risk. The NCD are favorite investment products due to their low risk. Second, more liquid. NCD have a highly liquid secondary market where the NCD holders can sell their NCD if they require liquidity. The NCD generally offer a return for investor at a higher rate than Treasury bonds. Typically, the yield is higher as well. Here are the disadvantages of negotiable certificate of deposit. First one, riskier than Treasury bills. The NCD are generally riskier than Treasury bills. It is due to the fact that the probability of a specific bank or financial institutions defaulting is larger than the probability of default of the government. Second, can be callable in some cases. Most NCD do not feature a call options, meaning that the financial institutions that offer them cannot recall the certificates and pay back the fund earlier. However, some financial institutions do offer callable NCD, which is large risk for investors in a period of low interest rate. The financial institution can call the NCD and pay a much lower prevailing market interest rate to futures investor or lenders. Here are the sample of NCD. So that's all for my part. Thank you.
Hello, my name is Sivathashann Analaki Pemal Naidu, metric number 261649. Okay, today I'm going to talk about repurchase agreement. A repurchase agreement, or known as repo, is a short-term sale between financial institutions in exchange for the government securities. The two parties agree to reverse the sale in the future for a small fee. Most repos are overnight, but some can remain open for weeks. They are used by businesses to raise cash quickly and also used by central banks. So the purpose of the instrument is to obtain cash or securities. A bank needing cash not having the necessary security may enter into a repo transaction with another institution by selling the repo securities in order to purchase cash. Other than that, repo and reverse repo have both been developed to fund big securities position, which are used to develop long-term leverage securities market. For example, an investor uses cash collected from an initial repo deal to purchase securities that in effect are repaid to collect more cash to buy more securities and so on. So as a result, the interest level of each deal is improved. So parties in repurchase agreement. The parties involved in repo is dealer, cash inventories, and clearing bank that function as intermediaries between dealers and investors. The repurchase agreement repos are conducted only with primary dealers. Meanwhile, the reverse repurchase agreement are conducted with both primary dealers and with an expanded set of repo counterparties that includes bank, government, sponsored enterprises, and money market funds. Reverse repos are commonly used by businesses like lending institutions or investors to lend short-term capital to other businesses during cash flow issues. So, right of issue each party in repurchase agreement. So on the seller or borrower, they sell leverage to the lender at a specific price with an option to buy back the difference at a set time and amount. On the buyer or lender, they provide the borrower with a cash loan backed by the share issued to the creditor and repurchase it from the investor. Next is the responsibility of each party. On the seller and the borrower, since it's effectively a collateralized deal, the lender will not be able to repurchase the security sold at the maturity date. On the buyer or the lender, the purchaser may maintain the securities and liquidate the securities in order to recover the cash lent. So security, however, may have lost interest before the start of the trade because security is subject to price fluctuation. So next is risk to each party. On the seller or borrower, when the worth of the difference is greater than the negotiated term, the borrower cannot sell the difference back. On the buyer or the lender, since the borrower only has temporary position of the party, these arrangements are also viewed as tax and accounting loans. And the benefits to each party, seller or borrower, repos has the opportunity to spend capital instantly, rendering its vital factor of liquidity. reduction activities. The scale of the demand and the supply of remainder allow for good liquidity. On the buyer or the lender, short-term borrowing arises owing to lack of liquidity. Okay, next is how is repurchase agreement traded. So you guys can see at the concept here, the model here. So first, the borrower have excess bond and need cash for certain period. On the lender side, the lender have excess cash in hand. So the borrower can engage in repurchase agreement, and the borrower will give the bond to the lender in exchange for the cash and agrees to buy back as soon as possible. After the time approach, the borrower will buy back the bond plus with interest. So the borrower receives the bond back and the lender receives money more than what the lender gave. So from the view of the borrower, it's a repurchase agreement. From the perspective of the lender, it's a reverse repurchase agreement. So next is pricing of repurchase agreement. In a repo transaction where there are two legs of transaction of selling the security and repurchasing the security selling price is usually based on the actual market price for absolute deals in first leg of the transaction for a closer date. Meanwhile, the price will be structured in the second leg, which is for future date based on the flow of interest and tax elements of exchange funds. This is caused by two factors. First is as the ownership of securities for repo period passes from seller to buyer, the coupon interest accrued for the period must be legally passed on to buyer. Thus, at the sale leg, while the security buyer is required to pay the accrued coupon interest for the broken period, at the repurchase leg, the initial seller is required to pay the accumulated to the initial buyer for the broken period. In the transaction-wise, both the legs are booked as spot sale or purchase transactions. Thus, after adjusting for accrued coupon interest, sale and repurchases price are fixed to yield the required repo rate. The excess of the coupon at the first leg of repo will represent the coupon interest for the repo period. Thus, the price adjustment depends directly on the relationship between the net coupon and the amount of repo worked out, based on the repo interest agreed on the total transferred fund. If the repo rate is higher than the current yield repurchase price, the upward adjustment will mean a loss of capital. If the repo rate is lower than the current yield, then the price of repurchase will be adjusted downward, which means a capital gain. Okay, finally, how does the instrument used in treasury operation? So repo. Under repo operation, banks borrow short-term money from the Bank Negara Malaysia. Bank sells eligible securities such as bond to the Bank Negara Malaysia, and at the same time commits to repurchase the equivalent securities on a specified date at a specified price which reflects the repo rate. Reverse repo. Under reverse repo operation, bank deposit excess fund with the Bank Negara Malaysia for 1 day. Such money will be considered as 1 day loan by the bank to the Bank Negara Malaysia. In addition, Bank Negara Malaysia will give an interest rate called reverse repo rate to the bank. The bank uses reverse repo transaction to provide liquidity to the banking institution, including lending operation under standing facility. Okay, so next is there any official guideline regulating this repo? Yes, there is official guideline. So who is the regulating agency in this repo instrument? It's Bank Negara Malaysia. Okay, that's all from me. Thank you.
In conclusion, in our group project, we are able to identify the money market instruments which is highly liquid and short-term cash equivalent instruments traded in Malaysia money market. Bank issue money market instruments such as commercial papers as a way to shore up short-term cash to make up for its daily deposits reserve shortfall. There are several features of money market instruments such as liquidity, maturity date, type of risk, advantages and disadvantages. Therefore, we need to understand in detail so that we will be able to trade money market instruments in the future. Thank you.